Alright guys, welcome back to my channel. For the new subscribers, thank you for subscribing. For the viewers, thank you for clicking this video. So in today's video guys, we are going to be breaking down how to master basic market structure using the ICC concept. Without further ado, let's jump straight into it. So guys, the ICC concept, ICC stands for indication, correction, continuation. Now, this particular strategy only works when the price is trending, right? So when it comes to actually breaking down market structure, guys, first off, you have to understand that we only break down market structure when price is trending, or we are only in trades when price is trending. And trending just basically means, price is going up, down, creating higher highs and higher lows. Now, the ICC concept basically states for you to enter your trade, price has to have already given you a sign that it is either going up and going down, right? So the indication basically states, okay, if price is trending, if you want to enter, price has to first indicate that it's going up, which is that first impulsive move, and then a correction, which is the retracement back, to our area of interest. And then from there, when price goes above our area of interest, we then now enter our trade right there. Stop loss below the low, and of TP, either we're going to put our TP at the end of, the indication, or we could just keep holding it and see where the trend leads. But this is basically what the ICC concept is, right? As you can see right here. So now, in terms of spotting it out on your time frame, the time frames that we actually use in this case here is the 1 hour and the 4 hour time frame. Why? Because I am a day trader. So a day trader, I usually stick with the hourly time frames, right? So for example, here I'm going to give you a very solid example. So this right here was a solid ICC playing out, in the sense that we already know that price was trending, and this was our area of interest right here. This was our area of interest right here. And as you can see, price gave you an indication that it was selling, that it now corrected itself, and then immediately it went below our area of interest, which is right here. In this case, this actually happened during the New York session. As you can see, immediately it did that. All you have to do is now put your stop loss either above the 1 hour low, or you pick a time frame and put your stop loss above that low, right? So in this case, I usually pick the 5-minute time frame to put my stop loss above it, right? So but it all depends on what you want at that time. So as you can see, guys, this was the actual move. So once you see that price is now below your area of interest, you basically just put in your buy. And when it comes to the time frame of entry, guys, you can literally use any time frame as long as you are in session trading that pair. So for example, with this particular gold trade, this happened during the during the London session, right? So me personally, I would wait around 2 a.m. Once I see the 5-minute time frame, right, a candle closes below that, I'm literally going to put my trade in and then find the best place to put my stop loss and basically ride that trade out, right? So again, guys, let me break down another ICC concept trade for you guys again. So another ICC concept trade was actually this particular trade. This was, I think, or the CPI, if I'm not mistaken. Let me check that real quick. Right, I think it was the CPI that happened that day. Yeah, it was CPI, right? So it's actually CPI. So basically here, how you would have actually caught this move was very, very simple, guys. So what I'm going to do is I'm going to clear my screen real quick. It was the 4 hour time frame. So notice, guys, in the 4 hour time frame, when it comes to basic market structure, guys, in the 4 hour time frame, price was literally selling, creating lower highs and lower lows. And then all of a sudden here, it now bought up. Why did it buy up? It's very simple, guys. Price ended up creating a low here, a body close low here. And the high that created that low is actually a pretty valid high, right? In the sense that if price was to break this high, then I would assume that the gold has changed trend. The reason why I pick this high instead of, for example, this high where price actually broke but then it still sold was because, guys, you have to pick the best high, or like the most, I would say the most realist high for you to pick from. So the reason why I would pick this one was because while it was selling, price created at least two solid buy candles, and then created at least two solid sell candles, giving you that good elbow for you to use as, you know, your demand zone for the entry. Right. So when price now broke this, I literally placed my box right here, and then you could either end the wick here or put the box at the end of whichever wick. So basically what happened here was when price now broke this, I waited for price to retrace, do what it has to do. So it did this, did all this consolidation, and then around New York session, if I go to the 5-minute time frame real quick, so around New York session at least 7 a.m. So 7 a.m. was probably right here. So right here was 7 a.m. So I personally probably put my stop loss like this, and then either put my TP 50 pips or maybe below here, and just because it's CPI. But obviously I actually wasn't in this trade, but let's assume, you know, all things actually went well, then this is how you'd have probably entered this trade based on the ICC concepts. It's really that simple, guys. So again, guys, let me break this trade down again. So in the 4-hour time frame, price came, created this solid elbow, and then now broke past it, indicating the change in trend. So now notice how again price created another two solid sell candles before it now bought up again. So now this would be considered a really valid high for us to say, okay, if price was to actually break below this right here and close below this in the 4-hour time frame, then I would consider this as a break of structure in the 4-hour time frame. So right now, gold is currently bullish in the 4-hour time frame, and for me to consider gold to be bearish, it has to break past below this low here and close below. Not this low now, but this low. Why? Because this is a really solid elbow that price has created. Now, some people might think, oh, why not this? The reason for this is because the price did not create at least two solid sell candles in an uptrend, right? For us to consider that as the main demand zone or low that we use to, you know, analyze our chart. So right now, guys, with that being said, how I would actually analyze this chart right now is in the 4-hour time frame, I would put my demand zone from this box to this box here, right? That's the first step, literally. And all I'm anticipating in the 4-hour time frame at least is for price to come back down here to then now sell, or maybe price creates maybe two solid sell candles and then now creates another high for it to then now retrace again, instead of coming back down all the way here, but it just retraces back here and then now buys back up. Right, so this is basically what I'll be waiting for in gold with the 4-hour time frame. Then if we go to the 1-hour time frame, notice how price has actually created at least two solid sell candles before it now shot up, closing above the previous high of the body close. So in this case, in the 1-hour time frame, price has to literally close below this area here for us to say that price is bearish in the 1-hour time frame. So how I would mark up this chart is very simple. I'll put my box from this to here, and then I'll color grade this as gray. Now you can easily put it here too. It all depends on choice. The reason why I did mine here was because, you know, it's much more smaller box and I'm waiting for price to actually retrace down, and then I'll find my entry, right? So this is basically how I would break down the markets. It's really that simple. So in terms of your entry, guys, our entries are basically coming from either the 1-hour box or the 4-hour box. So for example, in this NAS 100 trade, I'm actually going to give you a really solid example. I actually lost this trade because I used the wrong lot size, but it is what it is. But basically, guys, literally what I saw in the morning, literally before this whole move happened, right? Literally what I saw was this. So notice how price came, created this high here in terms of the body close, and then did all this, you know, consolidation or whatever. And then if you notice here, price now closed above the previous body close here. It might be small, but it's something. So when price created this high based on the body close, all I did was, okay, where's going to be the next, or where's going to be the, where will I mark up my demand zone? So me personally, I chose this as my demand zone right here. Why? Because this was the previous elbow that was created, right, to create the high. Again, it had two solid sell candles, and then it now created that high. Now we might say, okay, why not pick this one? Well, we could pick this one if, let's say, the high that was created, they didn't create too solid. We could actually pick this one, but the reason why we don't pick this one is because the previous, it's not the previous, low that created the latest high. If anything, this low here created this high, and that was basically it. You feel me? That's basically it. But this low here created this high, and because it had at least two solid sell candles, then we're going to mark this as a valid demand zone for us to mark up, right? So we're not just marking up any demand zone, like for example here, and expecting buys or whatever. No, we're marking demand zones based on some certain criteria, which is at least having two solid, sell candles in an uptrend. If it's a downtrend, guys, it has to have at least two solid buy candles. So for example, I'll give you a very, really, really solid example here. So what I mean by this is very simple, guys. So notice how price came, created this low, the body close, right? So me personally, I wouldn't wait for price to break this high or this high. I would wait for price to break this high for us to consider the 1 hour as a break of structure, right? So notice how even though price came, bought up, it's still, even though it tapped the zone, it still managed to sell back. Why? Because truly, the actual high that price needs to break in the 1 hour time frame is actually this high for us to now consider it a change of structure. But in this case, it did not. It just tapped it, and then as you can see, it sold off. So this is basically an example of what it is. So with the ICC concepts, guys, it's just basically indication correction, indication correction, indication correction, continuation, indication correction, continuation, right? Another indication, correction, then continuation. It's really that simple, guys. It's all about mastering the pattern. Now, in terms of marking up your charts, guys, literally all we are doing is just marking up that swing highs and swing lows, right? So for an uptrend, we're basically marking up these areas here. Try to figure out where we could mark up these particular areas here. If you can figure that out, you're basically done 50% of the work, right? Because if you can figure out where you can mark these, or where you can figure out these highs, right, you're basically done 50% of the work, because all you just have to do now is wait for session to hit. So in my case, New York session, and then once price is in New York session, wait for price to either give you a break of structure on this area here or just go above it. So in this case, let's assume it's 7 a.m. and price is currently under it, so you don't take your trade. Wait for price to go above it with a close candle. So you could either pick the 5 minutes, the 15 minutes, the 30 minutes, but make sure that candle is closed. And then once that candle is closed, you put in your entry over here, and then your stop loss should either be below, obviously going to be below market structure. You have to pick now what time frame are you going to use as market structure, because every time frame has different lows that will be broken for that time frame to be considered the break of structure or a change of trend, right? So in my case, I usually use the 5 minutes or the 15 minutes, but sometimes the 1 hour can give a really great risk to reward where like the lows was pretty close. So for example, I'll give you a really, really solid example here. So with this particular trade here, right, usually, sometimes this low here can be way down here, and if you were to put your entry here, you probably have to put your stop loss way down there to follow that low. But notice how, because the low was very close to our entry point, we could easily use a 24 pip stop loss. But that's not the case most of the time. But I'm just saying we could easily use a 24 pip stop loss. So this is just basing your stop loss based on what time frame that you want to use. But yeah, guys, this is basically the whole video on breaking down the ICC concepts. I hope you guys really gained a lot from this. If you have any questions, make sure you comment down below, and I will see you guys in the next video. Peace.